If the BOC starts cutting rates during the rate cycle and we start seeing rates decline by 1% over the course of the next 12 months, one of the biggest things right off the bat is we're going to see an increased amount of demand for money. That needs to be said. The cost of...
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
Well, depending where you were on June 5th, 2024, you were either jumping up and down, screaming excitement, or nervous about the potential of what could happen going forward. Because, well, Tiff Macklem and the Bank of Canada decided to do it. They did it. They actually cut interest rates for the first time in years. In fact, since 2020, they cut the overnight rate by 0.25%. Now, that's not anything to write home about, but at this point, it's enough to consider the impact and the implications publicly. So what that looks like, but also just genuinely speaking, what that will mean for the average homeowner, average mortgage consumer, the real estate market, and the economy as a whole. Now, for the conversation today, I'm going to focus my time on the real estate market and the lending market and what the impact of this will mean and how this rate cut could impact the marketplace as a whole. But before we get into it, let's talk about where we're at right now and what actually happened. Well, the BOC actually decided to cut interest rates, which means the overnight rate sits at 4.75%, which by no means is any reason to majorly celebrate. We are far above where we are hoping things to be, and we're still way too high as far as where interest rates are. But the truth of the matter is this is the sign for a lot of people that there is a little bit of a softening and a little bit of relief on the horizon, which for a lot of folks out there, it means a lot. It means a lot. And it's interesting to note that just genuinely speaking, this is in the last 6 to 12 months, I've had more people talk about the Bank of Canada rate announcements than any time in my career, going back almost 13 years now. And, looking back in history, I don't think just people were ever even aware of the POC's announcement. So what happened here was such an interesting thought process on how the markets changed, how information changes, and how it impacts decision making. Last week, we saw a countless number of our clients get accepted offers in anticipation of what was about to happen on Wednesday. And literally the moment the BOC decided to cut interest rates, my inbox flooded with emails, whether it be people who were currently pre-approved, currently people who had an existing mortgage, people who were thinking of buying homes. It was a whole whackload of information. The purpose of this conversation is more importantly is going to be what this could mean for the marketplace going forward. But I think I should get some facts out of the way really quickly and talk about how people are actually impacted and what this is going to mean for the housing market. So the first and most important thing, the biggest impact right away is for somebody who has an adjustable rate mortgage. That's a variable rate where the payments go up or down, where they see a difference of about $14 to $15 per month drop for every $100,000 that they borrowed. Now, this depends on their amortization period and the interest rate they have, but that's a rough calculation that we could use today. For fixed rate, variable rate mortgages, so we'll call them frozen payments, VRMs, payments that are set in stone, the ones that everybody's screamed about that have trigger rates, those are going to see a reduction in the amount of interest payable. Now, a lot of people have actually elected to increase their monthly payments, so it'll be a nice surprise for some folks who have increased it all the way up to the maximum, noting that now they're paying down more principal. How much exactly? They're paying about an extra $20 less towards interest and $20 more towards overall principal for every $100,000. For those people who have home equity lines of credit, they're paying about almost $21 less for every $100,000 that they borrowed, which is another welcome sign for not just genuinely people who have real estate and have HELOCs, generally people who have HELOCs, but people who are investing in the marketplace, people who have need to use their HELOC for emergency situations. Everybody's feeling a nice little bit of relief when it comes to that consideration. Now, we'll talk about what the impact of that will be, like I said before, on the actual marketplace. And I've got some thoughts myself, but here's where things get a little bit confusing for a lot of people. I'd say about 70% of the inquiries, 75% of the inquiries to me on Wednesday morning or Wednesday through the day and Thursday and continuing on were about, hey, what happens to fixed rates now? I'm in a fixed rate mortgage. What exactly is going to happen? Well, as we all know, the Bank of Canada only controls the overnight rate. The overnight rate impacts prime, and prime impacts variable rate mortgages and lines of credit and all loans and debts that are based on prime. It does not have a direct impact on fixed interest rates, although it is important to note that for the past week, we saw the 5-year bond yields, which are typically a good estimate of future values of fixed rates, go down almost 40 basis points until Wednesday. Now, one note about the bond yields is that we also saw that revert and jump right back up on Friday with some US information and US news, which means that fixed rates, although they typically will follow the bond yields, they have not followed yet. Although we will likely see fixed interest rates go down if we get a more favorable CPI data, which is going to come out in June 25th. It's important to note that when it comes to fixed interest rate mortgages, although they typically follow or they do follow the bond yields, it's not like the Bank of Canada where they drop the rate and then tomorrow your interest rate is lower. Fixed rates could be based on a period of time and they future value them. So when they purchase the mortgages themselves, based on where the bond yields are at, they're priced in at that time. And so for us to see a decline in interest rates, we typically need to see the bond yields hold steady at a certain point in time for a week or 2 weeks before you'll start to see the banks react and start to reduce their interest rates if they do at all. Now, some of you have been listening to my podcast for a while. You know that in many situations, the banks don't actually drop their advertised rates, but they will drop their actual interest rates after negotiation, which means you're probably paying more if you're going to the bank in short, but they'll give you a discount afterwards, depending on where the yields are at. We haven't seen a significant impact yet. And throughout the entire week, we watched most of the banks stay pretty steady where they were, with only about 0.1% reduction in insured rate mortgages. Insured mortgages are typically for folks who are purchasing properties with less than 20% down. Now, fixed rates, obviously, we'll wait and see what happens. But again, my suggestion is that we'll probably look to see the bond yields stay low until at least June 25th. If that comes in favorable, we'll start to see fixed interest rates slowly work their way back down, but not quickly. And the markets are basically saying the same thing as of right now, as of last week. The market was pricing in fixed interest rates declines of only 0.5% over the course of the next 1 to 2 years. And so as things stand right now, what you see is kind of what you get for fixed rates, although anything could happen. So we'll see what's going on there. Now, looking forward, after Wednesday, the markets changed slightly, and they're anticipating only a 42% of a rate reduction again in July, with the market basically saying 100% chance of the market reducing interest rates in September of 2024, which isn't surprising because TIFF will want to see the impact of this quarter point work its way through the markets for 1 to 2 months before they make a decision. And that likely puts us in that September timeline as opposed to July timeline. Right or wrong, it's almost guaranteed that's what we're going to see kind of moving forward here. Now, one of the most misunderstood parts of this whole BOC rate reduction is the fact that when the Bank of Canada lowers interest rates and variable interest rates are higher than fixed interest rates, it doesn't mean you qualify for more. Right now, housing affordability is the worst it's been, well, not on record, but it is one of the worst timelines we have seen on record. And if we consider the Bank of Canada lowering rates has not actually increased affordability, the primary consideration that will impact, the primary reason that this BOC rate decrease will impact the marketplace doesn't have anything to do with qualification. It purely has to do with people's interest in the marketplace, activity based on psychology, people feeling like it's their last chance before house prices go up. And they're probably not wrong to a degree in terms of what that might look like. You know, as an example, Royal LePage's CEO, Phil Soper, said this will no doubt spark activity and put upward pressure on house prices in the second half of the year. And a lot of research basically said that almost everybody was putting, not everybody, but 50% of people were putting their housing search on hold until they saw that the bank started to decline. I guess they wanted to have the safety of moving forward. On the Royal LePage study that I referenced, they suggested that half of sideline homebuyers were waiting until interest rate cuts before they go home buying. Now, the majority wanted to see 2 cuts according to the study itself, but based on last week's activity, just for myself and my team, I would suggest that there's a large group of people that are jumping back in the waters very quickly. And the increased amount of foot traffic in open houses, based on talking to many of our real estate partners, suggests much of the same. Now, it's important to note that increased housing activity doesn't necessarily mean house prices skyrocketing, as a lot of people tend to believe. And it doesn't mean that everything is going to fly off the shelves, because as we know, over the last couple of months, there's been a massive amount of supply built up, and a lot of people that have not been pricing their properties very effectively, which means essentially they've been pricing their properties based on what they wanted to get a year or year and a half ago, but not what they're actually selling for today. So there could still be a high amount of supply in the marketplace. And what I anticipate what we'll most likely see is a lot of people actually bidding on well-priced properties, and many of those overpriced properties will continue to sit. Now, every city in every area is facing a different amount of demand, and the supply is different in each market. For example, I'm located right outside of the Vancouver market. Most of my clients are in BC and Alberta, with a few of them in the East Coast. And we're seeing that in BC in particular, definitely in the Vancouver or Greater Vancouver region, single family homes, anything with a basement suite, anything 3-bedroom or higher is just flying off the shelves. Now, we're not having the massive condo issues that there have been in Toronto and been reporting in Toronto, but we are definitely seeing a little bit of a slowdown in that condo market unless it's priced effectively. Anything priced effectively, anything priced accurately flies, and it has been flying very quickly. Now, let's get back to the mortgage consideration here, because a lot of people genuinely are wondering, what do I do? How do I pick my mortgage now based on the fact that variable rates are still higher? Well, we still have to remember one thing. A lot of it comes down to qualification. A lot of people have to qualify to their maximum based on the stress test being at still around 7.5% or 8.5% if you're taking a fixed rate today. So I've had almost every single one of my clients ask me, Alex, does it make any sense mathematically to take a variable rate today? Well, the personal circumstance aside, the answer to that question is yeah. In many circumstances, it does make sense if you can get the right terms to take a variable rate if you're following along and chasing the market down. Now, history suggests that if we followed the last 4 or 5 rate drop cycles, that we should see rates come down about 200 basis points, which is 2%, which just puts us right on track with where the Bank of Canada is telling us that we might land at 2.75% over the next 12 to 16 months. But with that being said, we also have to keep in mind there's a lot of variables which could occur, which could slow things down or reverse course. Now, the one thing that's stopping people from taking variable rate mortgages right now is purely qualification. Now, remember, if you're getting a mortgage, you have to qualify at the stress tested rate, which is 2% above the rate that you're getting. So if you're taking an uninsured variable rate today at the advertised rate of, say, prime minus 40 or prime minus 50, you're still having to qualify at 6.4 or 6.45 plus 2%, which puts you at 8.45%, versus, let's say, a 3-year fixed mortgage in that same uninsured space, qualifying at about 5.49. You're actually qualifying at about 7.49, which means you have to, in short, you qualify for almost 8% less money. That's the short version. When you're comparing the two options, I'm noticing that that's one of the primary reasons that people are sticking with fixed right now, is purely because they're qualifying based on that fixed interest rate. Now, I would suggest that we're also seeing a lot of people just start to dip their toes in the water and ask the question, and they feel more comfortable with a fixed rate based on what's happened economically in the last couple of years. And the most common fixed rate still continues to be the 3-year term. However, as I mentioned in the beginning, I did run the numbers, and mathematically speaking, if I were to compare an uninsured 30-year mortgage between a variable rate today versus a 3-year fixed rate today, you actually come out ahead on the variable interest rate over the 5-year term, based on the assumption that interest rates come down a total of 2% and maybe back up 1/4%, so 1/4% before the end of that 5-year term. And that's basing on an aggressively priced 3-year fixed rate between 5.29%. I used 5.29, but we could say 5.39 or 5.49, depending on what each bank is offering at any given time. Either way, it's something to pay attention to, and the rate simulations are real. So let's go back to where we land. Where do we land based on the forward rate market? We're going to land somewhere around 2.75 to 3% today. Now, it's not as low as we were pre-COVID. Pre-COVID, we were just over 2%. And then obviously during COVID, we were sitting at 0.25%, but it's definitely in the normalized range. It was where we were, I guess, in around 2009 and 2003, 2005, this range. And it puts us at variable interest rates in the end, somewhere in that 4% range, which would assume that fixed rates are going to come into the 4 to 4.5% range as well. which leads me to my next point. What are the key takeaways? What are we going to see based on what happened with this Bank of Canada move and this Bank of Canada rate change today? So let's walk through that. One of the big ones being, if the BOC starts cutting rates during the rate cycle and we start seeing rates decline by 1% over the course of the next 12 months, one of the biggest things right off the bat is we're going to see an increased amount of demand for money. That needs to be said. The cost of money is decreasing, which means the demand is going to go up, which is going to change a lot of things in the marketplace. We've so far had a record low year, which is saying something considering 2023 was an exceptionally low year when it comes to mortgage rate demand. And I anticipate with rates continuing to decline, we'll start to see more people looking for refinances, more investors being interested in the marketplace because the numbers start to make more and more sense, especially with rental rates having increased, and just generally speaking, more people getting money, borrowing money, because you could qualify for more if rates continue to go down on both angles. We'll definitely see more people continue to take variable rate mortgages. And I think we'll start to see more people pay attention to whether or not it's an adjustable rate or a fixed payment variable rate mortgage. That is going to be something that people are going to pay attention to. We're also going to start to see better short-term rates. Those 1 and 2 year terms aren't going to be priced 1% or 0.75% above the 3-year terms. We'll start to see the dip in those rates as well. But we talked about this in the beginning of my points right here, which is the renewal risk. There's been so much panic in the marketplace. It's mostly news driven, but definitely people are feeling a little bit of the pinch who are looking at their mortgages coming up in 25 and 26, pretty concerned about what the heck am I going to do in that marketplace when rates are at 5, 6, 7%. Well, those people are probably going to feel a little bit of a sigh of relief knowing that interest rates are going to decline 1 or 2%, which, although does have an impact on the renewal rates, going from 2% to 4.5% is not going to be ideal, but it's not going to be as dire as what people were concerned about beforehand. Another factor to consider here is that we're likely going to see a lot more conversation about price inflation and pricing of properties as a whole. Pierre Poilievre, oh my gosh, I can't even pronounce his name, but PP, whatever. He came out recently and posted in a conference, talked about how right now the current government, and I don't want to make this too political, but the current government is on track right now to have their lowest housing starts on record since they came into power. Now, in the middle of what we consider to be a housing crisis, they're not building homes, and they're certainly not building the right kinds of homes. If interest rates go down, it doesn't matter what anyone says. We still have a whole whackload of people who came to our country that want to buy real estate and then want to own real estate. The actual housing market will continue to go up, and there's not much they can really do about that other than, well, building more homes. And that's what we can see right here. What could we anticipate the banks to do based on interest rates going down over the next little bit? One thing that you'll start to see coming back again is the banks are going to start reaching out to clients, I think, especially with a lot of the government mandates, but I just think they will start reaching out to borrowers earlier and earlier, trying to get them to renew early and get them to refinance early. And I think there's a few considerations there if someone is looking to make that move. They definitely need to be exploring their options, because there's no doubt that if a bank's reaching out to get someone to renew early, there's a benefit to the bank to doing so and not a benefit to the client. With that being said, you're going to see a lot more competition in that space in the next 6 to 12 months and 12 to 18 months, both in the broker channel, the bank channel, and the direct to consumer channel, which is good news for the consumer, but it also is confusing because their own banks are going to reach out and say, hey, take this offer right now, or you're about to lose it. And we've seen that happen in the past. Now, I did mention before that we were going to see an increase in potential investor activity. One of the keys to that, when you consider the cost of borrowing, is investors typically like to utilize a home equity line of credit. And obviously, they like to look at the value that they're receiving, so cash flow from rent. If we look at the existing state of the market right now, we've seen nothing other than investor sell-offs, but most of those people who are selling off properties are those who didn't properly analyze them or couldn't make up the variable rate payments, and those didn't catch up with rent because they still had rent from pre the rate increases. I think the people who are real investors who are analyzing where they're at today are going to start to do better than they had previously. And I think that a lot of those people are going to be well capitalized and ready to start buying right now, especially with rates declining. Even those who are using their home equity lines of credit, which I touched on before, are going to see a huge opportunity in the marketplace right now before things take off. The rental rates are going up. We've seen the cost of borrowing slightly go down. Why wouldn't they be looking into the market right now? And I think anybody who bought in 2023, especially the second half and up until today, June, is going to be really, really happy with their choice, especially from an investment perspective, because the value is going to look fantastic in the next couple of years. Now, the last consideration that people need to think about is if the market does pick up, there's no doubt that we'll start to see banks slow down in terms of their turnaround times. We were getting used to seeing mortgages getting turned around and approved in record times in hours, sometimes a couple of days. We could anticipate that will slow down because with an increase in activity, the banks and lenders have not hired back a lot of the people that they were laying off last year with the market being so slow. So we can anticipate from borrowers a little bit of frustration around the timelines associated with that, which is another reason that you might want to be working with a mortgage broker who can educate you about those things as opposed to getting frustrated. Which leads me to an anecdotal point. Last week, not only did I get a lot of phone calls from people who are interested in what was happening in the rate marketplace, but I got a phone call probably once every 4 hours. So I tracked them. There was 8 last week during the working week. So quite a few calls that were related to banks either A, not getting people approved, B, not getting them approved in time, or C, people just not being qualified but jumping into the market right away based on what's happening in the BOC. So I think you're going to see a lot more, yes, competition in the marketplace, but you're going to see a lot more issues and a lot more people making quick moves that are not going to be beneficial to anyone else. So as always, we recommend you get properly pre-approved because there's no point in making offers in this marketplace, especially if it picks up, if you don't know where you're at right now. Now, the next rate announcement comes up in July, just over 6 weeks from now. And, there's going to be a lot of anticipation of where the market's going to go. And there's going to be a lot of people concerned and asking big questions about what do I do? Where do I go at this time right now? I think the truth of the matter is this is a small increase, but a lot of positivity. If you're somebody sitting on the fence and you're wondering where do I go as far as real estate's concerned, well, like anything else, you need to analyze your personal situation and ask yourself if it makes sense to get into the marketplace. And if you're someone who's a naysayer and you think the market is about to fall off a cliff, other than perhaps some overpriced properties and too many studio condos being built in Toronto, the market will pick back up. There is no doubt about it, and it will recover over the course of the next 2 years. My anticipation is that we'll start to see the market really pick up in 2026. And one of the big reasons for that is because, well, think about immigration. During 2022 and 2023, immigration was crazy. 2024, we've seen a massive amount of immigration. Most of those people don't typically buy until they're here, after here for 2 years, and they achieve permanent residency, a job, get some down payment in hand. And then, of course, during that 2026 year, we're going to see people decide to sell properties, probably because of the renewals that are coming up. So I would anticipate we've got a year or two of increases to house prices in many segments, not all segments. And 2026 is probably the next time we see the market really take off. But who knows? Things could change in a month, in 2 months, or 3 months. And I look forward to getting ripped apart in the YouTube comments for my predictions here today. If you found value in this, make sure to leave a review in Spotify, on iTunes, on YouTube. And remember, if I was stumbling on any of my words today, I am recording this at 10 p.m. and had a very long day. So I appreciate you for watching. Thank you so much. Leave me a comment if you found value in the information, and I'll see you on the next episode.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.